What's up, traders? Welcome back to Synthetic Alpha AI. Let's get into it. Have you ever bought at what looked like the absolute bottom of a range, only to watch the market instantly collapse and wipe out weeks of gains in seconds? That sickening feeling in your stomach isn't bad luck. While you see a safe support level, smart money sees an engineered liquidity trap designed to harvest your capital. Over a century ago, Richard Wyckoff exposed why 95% of retail traders fall for this exact illusion. Look at these two identical consolidation zones. One is a silent transfer of wealth to institutional traders, and the other is a calculated trap right before a massive crash. By the end of this guide, you will know how to spot the hidden institutional mechanics, so you stop funding the market and start trading alongside smart money. When an institution needs to buy $50 million in a currency pair, they can't just hit market buy. Doing that would instantly spike price through the roof, ruining their own entry. Instead, they build a trading range to absorb sell orders over time. It starts with a violent sell-off that suddenly freezes, followed by a sharp bounce that sets your high and low boundaries. Then comes the dirty trick, the spring. Price deliberately slams right through your support line, triggering a wave of retail stop losses and panic selling. To an untrained trader, this looks like a disastrous breakdown. But to the bank, that sudden flush of sell orders is the exact liquidity they need to fill their buy positions. Look at the volume. A real spring happens on low volume or snaps back inside the range almost instantly. If you keep getting stopped out seconds before the market shoots up in your predicted direction, your bias wasn't wrong. You just got swept right before smart money launched the real move. Now, let's look at the mirror trap, responsible for more blown accounts than almost anything else: distribution. Smart money uses your fear of missing out to create the exact buy liquidity they need to dump billions in profit. Enter their master illusion, the upthrust. Price explodes above resistance with a strong green candle. Breakout traders jump in buying, while short sellers get forced out of their positions. But while retail rushes to buy the top, institutions fill their massive sell orders directly into that buying frenzy. Before the candle even closes, price leaves a long upper wick and collapses violently back inside the range, trapping everyone who bought the breakout. If you've ever bought a high only to watch it instantly reverse into a drawdown, you weren't trading a continuation. You were the exit liquidity. Quick question. Have you been caught in a spring sweep or an upthrust breakout trap more often? Drop a comment below. I read and reply to every single one. So how do you look at two identical ranges on your chart and know before the move happens which one is the real trade and which one is the trap? Look for these three visual footprints institutions cannot hide. 1. Higher time frame location. True accumulation happens after a long sell-off at discount prices, while distribution forms at the top of an extended rally at premium prices. 2. Volume delta. During a real accumulation spring below support, volume dries up because selling pressure is exhausted. During a fake-out upthrust, volume surges as retail FOMO spikes, but price fails to hold those higher levels. 3. Reaction speed. A genuine Wyckoff spring snaps back inside the range within 1 to 3 candles. If price lingers below support or builds acceptance down there, it isn't a spring, it's a real breakdown. Now let's turn this into a mechanical execution rule set, so you can trade these setups with surgical precision. Rule 1. Wait for the reclaim. Never catch a falling knife. Wait for price to aggressively close back inside the range, confirming the sweep was a trap. Rule 2. The test entry. Your entry trigger isn't the sweep, it's the test. Look for a slow, low-volume pullback that touches the boundary from inside the range. Rule 3. Protection and target. Place your stop loss just beyond the extreme wick of the sweep, and project the height of the range to target the opposing liquidity pool. By letting smart money do the heavy lifting first, you risk a fraction of your account to capture massive 1 to 4 plus risk-to-reward ratios alongside the institutions. Now that you know how to spot these institutional traps, you need the right strategy to execute on them. Click the video on your screen right now to watch the next masterclass, and I'll see you over there.
That's it for today. If this helped, smash subscribe, and I'll see you in the next one.